This is Natasha D'Souza reporting for SALT Voices, and I'm here at the inaugural SALT Abu Dhabi with Troy Gayeski, the Co-Chief Investment Officer of SkyBridge. Welcome, Troy. Good to have you with us.
Yeah, it's great to be on.
Good morning. It's day 2 of what's been an amazing, 2 days already of SALT. We're looking forward now into the programming today.
Yes.
Tell me about, the panel that you were a part of yesterday, where you talked a lot about the bifurcation, in the market and what kinds of different opportunities are out there from an investment perspective. I'd love your takeaways.
Yeah, so what we tried to do is we tried to take people from different geographical regions of the world, represented from China, the GICC or the Middle East, and 2 from the US. Myself, I focused on the US and the bifurcation between the US consumer in corporate America, particularly in terms of credit quality.
Okay, so that's where the bifurcation is.
That's where the bifurcation is. And
okay.
so, what's really happened since the financial crisis, the US consumer has gone from being very profligate with their spending and borrowing to, some would argue, maybe too conservative, in that if you look at debt to GDP levels or debt to income levels, they continue to decline. You look at the savings rate, continues to go up.
Okay.
And so we're very fortunate in America because we have a strong enough labor market that the consumer can spend at a healthy enough rate to drive GDP growth, while at the same time continuing to improve their credit quality and increase their savings rate. So that's a very healthy dynamic, and that's why we're long assets tied to U.S. consumer credit. Now, on the bifurcation side, unfortunately, corporate America hasn't behaved so well.
What kind of bad behavior have they been up to?
And so it's not like it's pernicious, but the reality is there's been really cheap money for quite some time, and they've taken advantage of that, and they've really re-levered their balance sheets. So if you look at debt metrics, they're well above where they were pre-crisis levels, and they're only rivaled by where they were in the late 90s. And so unfortunately, what that means is that when you do have the next downturn, if you're long those assets, you're going to suffer pretty significant losses, and realize defaults in high yield bonds and even investment grade credit will be quite significant, even with a very minor downturn. So you won't need a financial crisis. You'll just need a run-of-the-mill recession to inflict significant losses on investors. And that's why that's where our principal short exposures are, to help protect our portfolio in that eventuality.
What would you qualify as a run-of-the-mill recession?
50 to 150 basis points. If you look at historical downturns in the U.S. economy, that tends to be where they are. The Great Depression was approximately 10.5. If you looked at the 92 recession, that was 90, 91, 92, that was about 1.5. 01 was only 0.7%.
Okay.
And the financial crisis was 5.7, which they're still arguing about, by the way. That's the funny thing about economics.
So when we talk about run-of-the-mill, if we are, and there's been a lot of conjecture about this, are we headed to a dip in the market?
Yeah.
We've had so many predictions about when that may be. What's your take on that?
Yeah, so look, fortunately, the risk of recession in the U.S. is still relatively low, although it's much higher than it's been in most of the post-crisis period. So we quantify that as there's a 1 in 4 chance we have a recession next 12 months, which the good news is there's a 3 in 4 chance we don't.
We don't.
We do not, right? And then secondarily, the thing we always remind clients about is there's the real economy, there's the fundamentals of assets, both of which are doing relatively well, but not as well as the last several years where we had better growth. And then there's capital markets, and capital markets, like the stock market, are very influenced by the Fed. And so this is one of the factors that people really haven't focused enough on. Many people have talked about how the Fed's cut rates 3 times, but what they've also been doing recently is re-expanding their balance sheet. They've effectively launched QE4. And so that's been a very powerful driver of the asset appreciation you've seen, particularly the last 6 to 8 weeks. And we expect that to continue.
Okay.
So there actually is a very low risk, but a risk we have to focus on, of developing another equity bubble or commercial real estate bubble, which unfortunately could lead to a bigger downturn in 2021.
Okay. So then talk me through, you talked about there's a 1 in 4 chance that there's a recession, but there's a 3 in 4 chance. Obviously, there's great things that you can do with your investments.
Yep.
Where are you directing, your clients in particular, and not just within the U.S., but paint a global picture for me, if you could.
Yeah, sure. So what we try to do at SkyBridge is generate mid to high single-digit returns with as little risk of loss as possible, right?
Okay.
And if you think about the challenges for investors now, you have equity markets, which are at their post-crisis highs in terms of valuation. The only time they've been richer was in late 17, early 18, when there was all the euphoria around tax reform and regulatory reform. And then you look at bond yields, and they're unfortunately incredibly low. So it's a really tough environment to project out and have attractive returns. So we feel if we can make mid to high single digit returns with much less downside, we'll comfortably outperform fixed income, where you're looking at 2 to 3% returns.
So stay middle of the road, basically.
Somewhere in between, right? And so the principal way we're doing that now, again, is being long consumer credit, particularly U.S. RMBS and multifamily CMBS, where we feel the fundamentals continue to improve. And in order to protect on the downside, have the short positions in U.S. high yield and IG. Now, we're not biased against the rest of the world, just for the record. But when we look out at Europe, for instance, I mean, Europe's a train wreck. You know, it's very tough to have monetary stability without political stability. Unlike the U.S., if the employment situation in Pennsylvania isn't so good, you can move to Texas. It doesn't really work that way. Germans don't move to Spain or vice versa. So there are a lot of problems there. And even though the U.S. is growing at a reasonable rate, Europe's struggling to avoid a recession. So we have no ambition to invest in Europe anytime soon. And if you look at emerging markets, unfortunately for public investments in emerging markets, one of the biggest drivers is always the US dollar. And the US dollar has been relatively strong recently. And even though the Fed has eased policy, it still hasn't come off. So there is upside for investors if the dollar can meaningfully weaken. But in that environment, you'll still get very healthy returns in US equities. So right now, even though we're not heavily involved there, when we compare emerging market equities to US equities, we still would advise clients to keep their exposure more concentrated on the US.
And then tell me about your experience here, at SALT Abu Dhabi.
No, it's fantastic.
What's it been like for you?
Well, I'll tell you, the UAE is an amazing place.
Is this your first time?
No, it's my second time.
Time.
So I don't consider myself to be a provincial American. I like to think I've traveled around the world quite a bit, but it's rather remarkable what they've done here the last 30 years. And it's a reminder that policies matter, right? You need political stability. You need personal stability in terms of safety. Fortunately, Abu Dhabi in particular is blessed with healthy capital levels. But you still have to make decisions to encourage capital formation, have the rule of law.
You need that visionary leadership to be able to,
100%.
Make that happen.
And so, when you come to this region and you see the wealth creation, the entrepreneurial spirit, how they embrace, different cultures, embrace immigration from all different parts of the world, it's a healthy reminder that, again, policies matter. And you have to have that cosmopolitan entrepreneurial spirit where you're attracting the best people from all around the globe. And that's something the UAE has actually done incredibly well, particularly in this region, which, as you know, unfortunately is less than politically stable.
True.
In general.
I think we're lucky that we're in the UAE is such an island of stability.
That's correct.
In what can be of sometimes volatile geopolitical
100%. And so I think some of the takeaways for us is that, again, as Americans, we take stability for granted. Here, it's not. Obviously, you have the big threat from Iran, which is a constant issue. When you look at growth prospects, the growth prospects are very healthy. Obviously, there's a desire, and to put it in terms that most Americans can understand, it's similar to like Houston, right? Where Houston has had this very energy-dependent economy for quite some time, and they've diversified that away into healthcare and services. And that's very similar to what Abu Dhabi and the UAE have done, particularly Dubai, but now Abu Dhabi is, they're never going to completely be immune to the volatility in oil prices, but they're trying to diversify their economy. And so far, so good.
Yeah, but that's what's going to set us up for future sustainable growth.
That's correct,
Now, tell me about SkyBridge and your work in the Middle East.
Yeah. Well, so we've been fortunate in that we've had quite a substantial number of sovereign wealth funds that have invested with us over time from the region. Where obviously part of this is to attract more capital. But the other part is, are there any pockets of expertise we can bring to the region, whether it's something like this, which is a big brand and awareness exercise, both for ourselves and for Abu Dhabi. Can we partner with local financial service firms to help bring employment and cultural and financial opportunities here? So we're always trying to figure out how we can help the local regional partner, like we did when we had the conferences in Singapore back in 2011, 2012. So how we can help the Abu Dhabi authorities, and then in turn, are there any business opportunities that we could get from the region?
Okay, well, wonderful. Yeah. It's been great speaking with you.
Yeah, great speaking with you as well.
Thank you so much for being with us.
It's
and it was really good talking to you. Thank you again.
Pleasure.
Thank you, Troy.